Hi there, guys. All right, so with finance, hopefully you guys are going through your credit unit. You should have learned about credit scores. So just a quick refresh, everybody gets a credit score. We don't necessarily see it all the time, but it is a good idea to have a general idea about your credit score once you have a credit history. So in order to have a credit score, you need at least a credit card. Credit scores range from 300 to 850, but it's not really an even scale. So to be considered to have good credit, you really need about above a 700 of that credit score. And the best way for you guys to get a credit score is to get a credit card or at least be an authorized user on your parents' credit card, assuming they have, good repayment history. And that will start helping build your credit. Why we need a good credit score is in order to kind of help us get better interest rates on loans. So that's kind of where we're going to be talking about now. We're going to be moving into loans. Now, for most people, it's pretty well inevitable that at some point in our life, we will have a loan. Now, that could be a car loan, that could be a mortgage or a personal loan, a business loan. And people can make really big financial mistakes when it comes to loans. So it's really important that you do understand where your money goes when you are repaying a loan and that you understand how the interest can build up and ways to lower the interest that you owe. So there's a lot of different ways to kind of set up a loan repayment plan, and being educated about how to tailor that so that it will be the best for you is going to be really important. So we're going to kind of talk a little bit about loans in general and how that loan repayment schedule can really vary the amount of interest that you pay. Okay, so first off, when it comes to receiving a loan, you're not necessarily automatically guaranteed to get it, right? So you're borrowing money from the bank, and they're going to kind of consider what are called the 3 C's: your character, your collateral, and your capacity. And let's talk about what that means. So when you create kind of a loan application, they're going to look at your character, and this is how reliable are you to repay that loan. So this is going to include a look at your credit score. If you have a really bad credit score or no credit score, if you don't have any credit cards or credit history, they might deny you. This is going to include things like your criminal record and years living at the same address. So that kind of somehow creates a picture of maybe how stable you are. And they might ask for character references. They're then going to look at collateral. So I'm going to talk about what assets are. Collateral are essentially, it could be an item, or it could be, your bank account, financial or physical items that they could ask you to sell, or they could just take in order to help repay the loan if you default. I'll talk about that. The other one's going to be capacity. Again, the ability to repay the loan. So they're not going to give you, hundreds of thousands of dollars of loan if you don't have a stable job or way to pay that back. So they're going to look at your overall net worth, which is essentially a calculation based on the amount of money you might be bringing in and the loans and credit you might have. They're going to look at your overall living expenses, other debts, perhaps the education you have, and your stability of your income. So those are things to keep in mind to help kind of create yourself a good financial profile by, having good credit score, obviously avoid criminal record. That's general good life advice. Considering what collateral you might have, and of course having a good income. That will get you the best profile to hopefully be approved for loans you may need in your future. Okay. So it's important that we understand the terms assets and liabilities. When we're talking about net worth, this is about taking your total assets and subtracting your liabilities. So what are those? Assets are things that you own. So this could be a stock, that could bond, any real estate like housing, cars, or money and savings. So they're considered things that could provide future economic benefit. Now, liabilities are things that you owe. So let's say you have a car, but you still owe a lot of money on the loan. That's considered more of a liability. Same thing with a house. If you have a house, but you still have hundreds of thousands of dollars on the mortgage, that's a liability. Okay. So in terms of collateral, collateral is basically an asset that the lender could accept as security for that loan. So let's say you're borrowing, $20,000 and you have a car worth $20,000. You could put that car up for collateral, which means you're agreeing that if you cannot pay back the loan, the lender could actually take your car as collateral so that they could sell it and get that money for them to have that loan money. So it can be physical items that the borrower kind of takes as an item or as like security if you can't pay the loan back. So people might have their car for collateral or a house, for example. Okay, so let's talk just quick practice here with assets and liabilities. So a car loan balance of $4,000, that's going to be a liability, okay? It's some money that you owe. House valued at $175,000, that's an asset. That means that that's probably equity you have in that home. Interest on savings. So remember, interest on savings is good. Credit card balance, that's a loan, so that's a liability. Mortgage balance, again, money left to owe. Car valued at $9,000, that's an asset. Gold coins, not many people have it anymore, but it's an asset. Emergency cash, asset. Stocks, asset. And savings account, asset. So hopefully that gives you an idea of what are assets and what are viewed as liabilities. Okay, that brings me to secured versus unsecured loans. These are two general categories that are based off of collateral. So a secured loan is where you have an asset used as collateral to essentially secure the loan if you are not able to make the payments. A secured loan will often offer a lower interest rate because the lender is a bit more confident that in some way or another, they'll be able to recover the loan payment. An unsecured loan is one that does not require collateral, but if you do default, you could be sued for that money. So again, secured loans generally offer a lower interest rate. So let's talk about then what are secured versus unsecured loans. So some common examples of secured loans could be mortgage, car loans. Those are kind of the two main types, because if you were not able to, pay them, there's physical items, the house and the car, that the lender could take. Okay. There's also things called secured credit cards. This is not applied to every credit card, but you can get a secured credit card where essentially you put money on the card up front in order to help build yourself a history. Okay, other unsecured loans, credit cards are often unsecured if you're using them, your typical use. Personal loans, so this is where you just go to the bank and you take out $10,000 for whatever reason that may be. Okay, maybe that's to do house repairs, maybe that's for, a trip, whatever it is. But there's no physical item attached to that. And student loans. They cannot take your degree from you. That's not really a physical item that's worth anything. So that would be considered unsecured. Okay. All right. This is really important. We're going to now talk about amortized loans. This is all about that schedule I was talking about and how we can learn how to pay the least amount of money of interest on our loans. So what an amortized loan is it's a loan with scheduled payments. All right. It's a payment plan, and it is where your money goes to both principal and interest in a certain amount every month. Okay. Principal is the amount of money that you borrowed, and interest is obviously the amount of money accumulating that you also owe. So with amortization, it's again a scheduled breakdown of how you will pay your loan back each month. All right. So every month with an amortized loan, you actually pay interest first, and then any remaining payment goes towards the principal. and I'm going to show you kind of how this looks. But over time, as your balance decreases, because you're slowly paying off your loan, over time the amount of interest you owe decreases, and the amount you're putting towards the actual loaned amount, the principal, increases. Okay. Ideally, what you want that principal to decrease, because that's lowering the amount of money that you have outstanding to pay back. Okay. Common amortized loans include mortgages, car loans, personal loans, and student loans. So basically any large loan besides a credit card. Okay, so let me show you what an amortized loan looks like. Okay, this is just a bank rate loan calculator. Let's say, for example, we're going to borrow $10,000. Okay, I'm going to pay the loan back in 5 years. So with an amortized loan, you'll have a loan term, and it's going to have an 8% interest rate. Okay, let's calculate that. So what I want you to be looking at here is the monthly payments, the total principal paid. So again, that's $10,000. That's obviously what I borrowed. And the total interest paid, $2,165. So with this amortized loan, I'm going to be paying $202.76 every month. The idea with an amortized loan is that the monthly payment doesn't change unless you choose to pay more. The interest is really important here. We want that number to be as low as possible, because what's happened here is that $10,000 that I borrowed in the end is costing me $12,165. I'm going to click here to show amortization schedule. Okay, this is what an amortization schedule looks like. I'm paying monthly, so I have the same payment every month. If I look under payments, sorry, my pen doesn't work anymore, so I can't show you. Look under payments though. Every single month, it is the exact same. All right, that's the idea with amortized loans. If you have mortgages or cars, it's the same monthly payment. Notice how in the principal and an interest column, they're different. So at the start, look at June 2020, interest is $66.67. As we go on, the amount of interest you're paying is decreasing. Okay, because it's a set percentage of 8% of your kind of loan. The amount of principal is increasing. So over time, your payment gets broken down into principal and interest. At the start of your loan, you're going to be paying a large chunk of your payment towards interest, and over time, the principal will increase. Okay, I know this is confusing. You're going to have actually an assignment to kind of practice this. But let me show you some really key things here. Let's say $202.76, that's too much for me to pay. So whoever I'm lending to says, hey, you know what? You can lower that. Just simply increase your loan to 8 years. Now watch what happens. Okay, my monthly payment is $202 and my interest is $2,165. They'll say, no worries. You can take out that loan for 8 years, and you'll only have to pay us $141 each month. But look carefully at the interest. The interest I'm now paying has increased to $3,500. So my $10,000 is now costing me $13,500. Okay, still too much money. They'll say, oh, no worries. Take your loan out in 10 years. My monthly payment lowers, but again, my interest is drastically increasing. So the lesson to take away there is that the longer you take to pay back a loan, the lower the monthly payment will be, but you'll be paying more and more interest. Okay, so the way to avoid that is have a lower term rate. You'll be paying off more monthly, but that will accumulate you much less interest. Okay, that's very important, especially let's say you're going to take a car. They're going to convince you that you can pay less monthly by taking the 8-year loan, and you'll be paying that off with a lot more interest. Okay, let me see where we're at here. So let's just summarize a couple things here. When you have an amortized loan, the amount you owe every month is the same. You can actually choose to make extra payments or pay a bit more monthly to lower the interest, but other than that, your amount is the same. Why does the amount of interest you pay every month decrease? Okay, this is because the principal is decreasing. And the interest rate is fixed. So let's say, for example, your interest rate is 5%, your loan is $10,000. That first month, you're paying 1/12 of 5%, but then when your principal lowers, obviously a percentage of a lower amount of your interest is going to be less. Okay, I wish I could show you exactly how that works, but again, watch the video in the article if you're still confused. What happens to the principal paid over time? It increases, which is a good thing. Okay, you want your money to be going towards the loan and not towards interest. Okay, in the early repayment phase of an amortized loan, your monthly payment it's going to be mostly interest and a little principal. Okay, you're going to be paying more to interest typically. All right, it's time for Rhonda to start repaying her student loans, which are amortized over the next 10 years. Her first month's payment is $396. How much should she expect to pay the next month? She should expect to pay $396 because it's amortized and it's going to be the same each month. Okay, I really need you guys to understand amortization, so I'm providing you kind of a quick assignment. It's going to be using that bank rate calculator to help you practice how we can kind of decrease the amount of interest we pay in our loans. So please kind of look for that. Okay, bye.